Good day, fellow deal makers. On today's show, we're going to have a return champion, Mr. Tim, CEO of StackSource, who's got a big update for us, and we'd love to hear it. Tim, welcome back to the show.
Josh, thanks for having me.
Yeah. All right. So, what's the big news, man? I'm itching to hear it. What's up?
All right. Well, thank you for having me back for the second time on the Deal Scout. It was a blast the first time, so I know we've stayed in touch, and we're now a proud Deal Scout sponsor and partner. But when we talked months ago, the company was growing at StackSource for real estate capital markets, where we help people get money for deals, money for real estate deals. And we've been doing a lot of loan deals for the last 2-3 years. And we've kept growing in the loan space. As a matter of fact, we've more than tripled our originations in 2021 over 2020. But increasingly, we have these real estate investor clients ask, hey, you're getting me a great loan for this property, but I'm trying to work on 3-4 different deals at once. And I could be working on more deals at once if I could get even more capital on these deals, if I can bring on more outside capital. Can you get me more capital on these deals? Can you get me an equity partner? Can you get me subordinate financing based on the trust and the relationships we've built up? And so the big announcement is that StackSource has closed its first joint debt and equity placement. It was a $53 million acquisition of a multifamily asset in Texas, and we were able to bring 85% of the capital stack through debt and equity, and that's something we're extremely excited about, and extremely excited to replicate that on more deals going forward.
Wow. All right. So, for maybe the first time, commercial real estate investors, or for people in the audience, explain the magnitude of what just happened between debt and equity, and how you guys help syndicate that deal and put that deal together. Like, explain the magnitude of why that's important.
I'll go one step further back and say we're finally living up to our StackSource name. So the reason that we're named StackSource is because you have this concept in real estate deals of a capital stack. It's where is all the money to put together this deal coming from? So, okay, we're under contract to, in this case, acquire a $53 million, hundreds of units of apartments in outside of Austin, Texas. Where's the money coming from of that 53? Well, obviously, if we were in a simpler residential deal, if you were buying a home, you have 2 sources of capital. You have your down payment and you have your loan. And a lot of real estate investment deals are just that simple too. You've got your equity, which is like your down payment, and then you've got your debt, your loan. And a lot of the deals we've closed are people that are putting their own money in on a multifamily or another real estate investment, and we can help them find a lower interest rate. We can help them find more leverage or non-recourse. And that's traditionally been the big drivers of what type of financing people are looking for on our platform. Now, as you get into the middle market and larger deals, it starts to become more prevalent to use more than 2 sources of capital in the same capital stack. So you may have your common equity, that's your down payment, where it might be some of your money. It might also be other investors that you pool together. You have the highest potential return because you own the deal. You also have the highest risk because the lender is going to get paid back before you do. So your highest risk, highest reward. The other end of the capital stack, again, you still have that senior loan, that loan that is going to get paid back first, but it has a low interest rate. You may have an interest rate of 3.5%, and it's pretty flexible money. Now, in between, in this deal, to go back to the $53 million acquisition example, the sponsor had about $5 million of equity that they wanted to put in, and they didn't want to put in $10 million of equity to make up, because the maximum loan that we could qualify them for was $42 million. So about 80% or a little less than 80% of the capital stack, and it leaves $10.5–11 million of equity that needs to go in. Sponsor doesn't want to earmark any more than the $5 million. So we have a shortfall of another $5 million that needs to go into this deal to close it. The loan couldn't get any higher. Sponsor didn't want to use more of their own money or to raise more of their own money. And so what we sourced was a preferred equity partner. This sits between the common equity, which is the sponsor running the deal, and the senior loan. And there are other flavors of capital that can go in between. You can have what's called a mezzanine loan, which is kind of another piece of debt. In this case, it's a little bit different than that, where it's preferred equity. They are part owners in the deal, but they get some preference in the capital stack. They won't lose money as fast as the common equity does if something goes wrong on the deal, but they also won't make as much money when the deal goes right and when the returns are high. So the common equity makes the most money. The preferred equity that we sourced was from a different source than the lender, with a capital relationship that we've built up. And we're able to bring those two sources of capital together, make up about $48 million out of this approximately $53 million acquisition price. And this is a new one for us. It's not a new concept for the industry, but it is the first time that one online platform was able to bring multiple sources of capital in this way to the same deal. And for that, we're very proud of it.
Yeah, no, that's huge. To date, how many deals have you guys done? What kind of volume, maybe in dollars or in deals, have you guys done to date?
Hundreds of debt-only deals, hundreds of commercial mortgage deals where somebody is just using the platform to try to find a better interest rate, more leverage, or non-recourse, or something else that they want out of their loan that they're not getting from the lenders they know already. So we've done hundreds. As a matter of fact, in 2021, it was our first year doing more than 100 closings in a year for commercial mortgages. And we're a fairly new company. We launched in 2017. All of our growth has really come since 2019. So we more than tripled our business. We're imminently going to pass $1 billion of loans placed through the, $1 billion of, I should say, capital placed through the platform, since now it's not 100% commercial mortgages, but it's also alternative sources of capital that we're sourcing as well.
So let me ask you this question, kind of behind the scenes, right? Like, when that deal came across the table and you're like, the lender's like, this is the most we're going to go on this project, right? Did you have that offer ready to rock and roll, or did you guys solve a problem, kind of like fixing that, saving the deal, but then now becoming the first to ever do this? How did that work?
Yes. So equity deals are a lot more relationship based than so debt. And the reason why our platform is growing so fast on the debt side is, we can make it a bit more programmatic. Here is the exact criteria that these lenders are looking for, and we can match them or they're not matched. On the equity side, it's much more of a relationship game. And this is why it's taken us some time to get this part of our platform launched, is because we had to build up our own track record in the way we underwrite, the way we structure, and the way we advise these commercial real estate transactions. Now that we've done hundreds of the commercial mortgage only transactions, now that we're about to cross $1 billion of dollars placed through our platform, we've built up these relationships. And so, when a sponsor comes and says, well, I want to get maximum leverage, or I don't want to spend any more than 10 or 15% of the money here, and I want to boost the returns, that's automatically a signal to us, hey, there's not going to be a lender that's going to give 85% of the money in this particular context. There might be a specialized context where that would happen, not with your typical multifamily acquisition. And so that's a flag to us right away that, hey, it's going to take a couple different capital sources coming together and working well together and structuring that way. So our capital advisory team, these are people that are experts that have been real estate lenders, brokers, loan brokers, and financing brokers outside of the StackSource context. They've joined StackSource and they know what to look for and how to structure these solutions. And it's, those things happen in tandem.
Yeah, that's awesome. So from the sponsor side of the deal, like, I'm trying to get this deal done, I want to buy this multifamily building, I go to the bank and, I go to you guys, I go to StackSource, and you guys pair me up with the perfect lender, but I'm falling short. And I'm like, I'm not putting any more of my money into this deal. And you said, I got you, buddy. Let me introduce you to some other people. Now, who are those other people? Who are those other players who come in to fill the gap on a deal?
Yeah, so there'll be a few different types. And honestly, it's not a cut and dry, these are equity capital sources and these are, because sometimes it's other sponsors and other real estate investment vehicles. They don't have the deal that you have, but they're interested. I mean, they might have been interested in buying it themselves, but you're buying it and you have it under contract, but they'd be interested in partnering with you now on a JV equity level, equal partner. In this case, it being preferred equity. This was an equity fund. And so this one was a fund structure that is looking for these types of investments, and they like investing in the middle of the capital stack. So they like going below the common equity. They like being above the senior loan. And that's their calling card. They like being in the middle of the capital stack. So it'll be funds. It will be family offices here and there, where it's not a pool of investors that have come together. It's really one wealthy family that has put their own money into a vehicle to invest in real estate deals. And for larger deals and for larger investment amounts, then you start to get into this institutional private funds or real estate investment trusts that have money earmarked for different types of investments. Then you start to get up into, where you are really going to call it institutional capital. This is kind of like a mid-market, small institutional, would only start at something like a $5 million investment. This is almost as small as those types of funds can go.
Got it. So when that deal came across the table and you're like, man, we're coming up a little short, Tim hopped on the phone, made a few phone calls, and you had someone said, like, yeah, I'll play in that space. I like that sitting right there in the middle of the cap stack. That's our jam. Now, how did the deal mechanics go? How does that get structured to get this thing across the finish line?
Yeah. Okay. So the first cut is the property, the numbers, the location. Does the deal make sense at a base level? Hey, Austin is this growing MSA. There's tons of people moving there from California, and we know the story, right? But more than the story, do the numbers make sense? Are they getting, even from the sponsor's own projections, or StackSource's projections working alongside the sponsor, is it getting to the IRR that is even interesting for their fund? And is it going to be a good addition to their fund? The numbers and the property deal are first. Now, the really important second cut is, okay, well, these numbers look good. Like, it looks like the market rents in Austin are higher than this property is charging now. And there's a few simple upgrades we can make and get those rents, and it's going to make my money look, bigger than it is now. Who is doing this deal? And this is where the track record of the sponsor becomes even more into play than on loan deals and debt deals. They need to know, has this sponsor executed on other multifamily deals like this? Do they know what they're doing operating a property? Are they choosing a good property manager? Are they going to make all the right decisions where they're not going to screw up the investment for both of us? Because I am more of a passive partner here. I'm bringing money to the table. I'm able to make the deal happen, but I'm not running the deal. I'm not the general partner. And so they're looking at, who is that general partner? Are they trustworthy? Are they experienced? Do they know what they're doing with this type of property? Because at the end of the day, they're going to have to make decisions and run that property in a way that's going to achieve those returns that right now are just on paper. So the sponsor is the most important piece of the process once you get into this middle capital stack, equity placement, structured finance type of situation.
Yeah. Now that you guys have lived up to the full name, and you guys have been the first online platform to cross this path, how did you celebrate?
You know what? Our team is remote, so we have not yet thrown a party with like everybody on the team that helped make this happen. As a matter of fact, my colleague Beth in New York was the main contact on this deal and running this deal, and there were a couple of colleagues that worked on it. So we have not yet clinked in glasses and celebrated. So some of the simple team celebration is like sending GIFs to each other through Slack, and it's pretty lame, honestly, at a team level. We have that coming, Josh, when we do our next team offsite, which we're hoping is soon. I mean, we still have this, next variant of COVID is always coming out, but when we bring the national team together, this will be one to celebrate about for sure. But we're celebrating by working on more deals, to be honest.
Awesome. Yeah, that comes from a true deal maker, right? How do we celebrate? Do more freaking deals. That's what we do, right?
Let's get a press release out, and let's make sure people know that we can do this, and let's work on the next 5 of these.
Yeah, got it. So how do you, when you're going down this path, now that you guys have lived up fully to the new name, how do you scale that side of the offering? So you got the debt, right? You have tons of different banking relationships, more than anybody I've ever seen. How do you scale the family office, the funds, the REITs, mezzanines, and institutional? How do you scale that side of it? Because that is highly relational.
Yeah, it's highly relational. That's exactly right. And so part of what we're doing is not just, well, part of what we're doing is new features on our tech platform to make this, this new structured finance approach, more streamlined and more efficient. But that's far from a sufficient answer on this. The truth is we're scaling our capital advisory team. So we have these capital advisors. We've got an office in New York. We've got an office in LA. We've got capital advisors in Dallas and Chicago and Atlanta. And we are building the team further on the capital advisory side. So I have a colleague named Richard Caldwell who came on board 6 months ago. He is in Northern California in Sacramento, and he's got 30 years of industry experience as he's been a credit officer at banks and credit unions. He's been head of originations, offices for debt and equity brokerages. He's joined us and he's recruiting capital advisors across the firm. There are more cities where we need to have a major presence with these different debt and equity capital sources so that we can continue to draw on not just the connections with all these lenders, but all these diverse equity relationships, help to cross-pollinate capital sources from one city that really want to invest in others. Because this deal is a good example. It was a West Coast-based lender coming together with an East Coast-based capital source to get a deal done in Texas. And that is the world today. The world today, you want to look at the deals wherever they make sense, the best deals for you, not just your backyard, but to invest and lend in deals that are going to be a good fit for your portfolio, a good fit for your balance sheet. And so to enable more than that, we're continuing to build the team of capital advisors as well.
Okay. So you talk about scaling capital advisors, right? So you're going to get more people who can actually help get deals done. So you're a broker out there or an investor out there, and you're working on a project. They have people, so they go to the platform, but they have people, capital advisors, who could walk them through the deal and say, this is how we're going to structure the deal. This is how we're going to do the deal. And I'm going to fight for this deal because this is how I get paid, right?
Absolutely. Yeah. So we want the transparency and the efficiency of the platform, but you still have people fighting for your deal and also guiding through and providing expert support.
So in terms of capital advisors, like what's the goal? Like how many capital advisors do you want in the United States of America?
Yeah, we want to get from 12 to 30, in the near term, talk about 2022 and early 2023. And that's to keep up with the deal flow that we're already working on. And to continue to flesh out all these parts where we're expanding, including the equity placement and more things to come. There's going to be a lot of deals to work on. The real estate capital markets themselves are in a strong, robust state. Now, if you're any armchair economist, you know that inflation is rising and there are, you may think that there's bubbles in pieces of the economy. And I wouldn't tell you you're wrong. But for right now and for this next foreseeable period, we still have historically low interest rates, which haven't caught up with the inflation yet. We still have a heavy demand for many types of commercial and multifamily real estate across the country. That's going to be not only acquisitions and refinancings, but even still development of industrial and multifamily. And there's capital that needs to be put together for these. And we actually have more dry powder and capital sources competing with each other now than ever before. And all of those things put together mean this is going to be one of the strongest years ever for commercial real estate financing. And so to continue to meet that demand, we're building the team.
That's awesome. Now, that's not the only side of the team that's growing. You also had, you're doing hiring, you're building your internal team, focusing on other things. Like, talk to us about your other side of the team.
Yeah. So absolutely. We've hired software engineers, designers, operations people. Josh, I don't have to make the invoices anymore because now we have a finance guy. So we've become a real company in a way that we weren't a year ago. And honestly, it's been really cool to see that we have these different, both the operations side, the technology side, and the capital advisory side are all growing. And it's exciting for me because it's a new challenge. Instead of doing almost everything in the back office and building the tech, I'm delegating more and I'm leading more, and that's a whole nother challenge for me too.
Yeah. No, that's so cool. Super cool. I'm proud of you, man. I'm cheering you on. This is it's amazing to see like the growth that you had. So maybe the first time we chatted was maybe early 2021 or something like
Yeah,
that.
it might have been early to mid 2021.
So okay, so let's just say we have Tim today and Tim a year ago. What has changed in, like you're delegating more, you're learning leadership, but like what do you think is the biggest hurdle that you've overcome and biggest point of growth personally?
Well, we have a leadership team at StackSource now, like a real table, yeah, not a real table because I told you we were remote, but a proverbial table that we come and sit at monthly and have a leadership meeting where we say, hey, how are we doing? What's working well on our platform? What could be working even better? Is there any threats to keep an eye on? Doing that type of management, and that stuff was always in my head. But now talking about that stuff with the 8 leaders of our company has been a cool evolution. One that's been really inspiring to me because, the way that this team has come together, like all of these people are more talented than I am because I'm this jack of all trades founder. I can keep up on the marketing side as much as I can. I can, there are things that I can't do, but I've tried to keep all these things alive. Now I have these, kick-ass people that can do all of these things really well. And that's become, it's encouraged me and inspired me as a leader to say, hey, these people are smarter than I am, and they've got skills that I don't have, and they have experience that I don't have, and I can trust them. I can throw the ball to them. They're going to catch it and run with it in a way that I couldn't.
Yeah. Is there a resource or maybe a consultant or a coach, or is there something that you would say that was a pivotal support from helping me go from where you and I first started talking to now, like a book or course or something like that?
So I've always had an advisory board for the company. I think I'm relying on them more and more heavily now and with different questions. But a couple new things that I did start doing in the last year to 18 months. I joined a CEO advisory group. So the one that I'm a part of is called the C12 group. There are others that exist, various flavors. But that's been encouraging to see other business owners and the challenges they face, and kind of be able to bring, here's the issue I'm facing, and get feedback, not just from a team of experts, but hey, people that are running businesses and running the show, and their other CEOs. So that's been cool. And I am looking to invest into one-on-one executive coaching now. So actually over the last 3 weeks, I've interviewed 6 different executive coaches and gone through and whittled it down to a list of a couple of potentials. And so I'm investing in both of those directions as far as like, an advisory board, well, 3 directions: advisory board that knows what's going on with my business, CEO roundtable where it's different people dealing with challenges in different businesses. And then I'm investing in executive coaching. I'm doing it all.
Very cool. Out of all the things that you guys have overcome and grown through and to where you are now, looking back, what do you think was the most difficult thing for you as a leader, as the CEO of this company?
There have been a lot. I've had a lot of lessons learned, both through, hey, here's a really good person to talk to and they're high credibility and I'm going to try to learn from them. But truthfully, I've learned lessons the hard way too, on planning and product development and team. I will say the most painful ones are when you make mistakes in team building. Because if you hire somebody that you later need to let go, while it may be the case that they didn't succeed in their role, that's always a failure on the person that brought them in because you didn't see that they wouldn't succeed in that role. And so that's on me for the couple of people that we've brought in along the way, and it wasn't the right role for them. And they're great people, and there's a role out there for them that's going to be perfect, and they're going to be super productive, and it may not be yours. And so people mistakes are the most painful ones because it impacts the company in a real way, but it also impacts that person in a real way. So those are the ones that I really want to avoid going forward. I think I've gotten better at interviewing. I think I've gotten better at trying to make those things more objective and less gut call on what I think or somebody that I like personally. Does that mean that this is the right role for them? Because I think people mistakes are the most, they're lessons to learn that you really want to learn from.
Yeah. So I'm really excited to see how far you guys have come and where you guys are heading. But this idea of debt and equity is really massive, right? How will this impact real estate funds? You know, like what how does this benefit them, and how do you work with real estate funds for this kind of offer?
Yeah. So on both sides of the house, as far as, if you've got a deal under contract or one that you control, if you have a deal you control, you're a sponsor, and getting access to multiple types of sources of capital and at multiple tranches of the capital stack, obviously is a powerful thing. Now, if you're on the other side and you may be thinking, or you may already be set up as, hey, I can be a capital source. And I would like to see not just StackSource on that side of the marketplace used to only be able to say, hey, we can show you lending opportunities. Now we can say we can show you investment opportunities at the middle part or different parts of the capital stack. So that's something brand new that we can say to real estate funds that we couldn't say a year or two ago. And the opportunity is to scale your investment, basically scale your access to different investments and to grow your network of potential sponsors to work with. So, if you should continue to work your own network of relationships, but this is a way to build and to grow that network of relationships and deals that you have access to.
Yeah. I want to be careful about asking questions of things that I see coming up in the horizon, but give us an idea of things that are coming up in the horizon, right? Like, I know you don't want to let every cat out of the bag, but what's next for StackSource and you?
I'll give you another thing that's next beyond the structured finance, the debt and equity placement that we're starting to do. We're not abandoning our focus on making the debt process as streamlined and as helpful as possible, just because we're doing this expansion. So we have new features coming out for debt placement as well. One of those is going to be lender ratings on our platform.
Yeah.
So let me explain what the worst thing that can happen when you're seeking a commercial mortgage partner is. The very worst thing that can happen is you get a term sheet that you love and it never materializes because the lender retrades you or pulls out before closing. That is the worst thing that can happen. It's not calling a lender and saying, oh, I don't like your deal, go away. That is actually the second best thing that can happen to your deal. The best thing that can happen is you've got a reliable lender with a good rate, good terms, a term sheet you like, and they're going to follow through. That's the best thing. The second best thing is them saying no. So what do we do about these lenders that put out term sheets, or maybe they're going to honor their term sheet, but it takes them a long time to close. I mean, it's going to be 60 days. You only have a 45-day window on your contract. You need to know that up front. This is where lender ratings comes in. Not only do you get quotes back through the StackSource platform from lenders that are ready to play ball, but you're going to get information about, well, what did our other borrowers think of their process? Did they close on time? Was their process clear and efficient? And have they retraded other borrowers in terms based on minor things that they found in underwriting, and making that transparent alongside the actual rate and terms that lenders are quoting is going to be another powerful feature on our platform. And so we've been collecting that data for hundreds of transactions. And now that we're starting to get more information for all these lenders, we're going to start to publish that. So get ready for Yelp reviews and Uber driver type reviews for your commercial mortgage lenders.
Man, what a great opportunity on the flip side. So companies or finance company have done a ton of deals, but maybe they're not, we're starting to see gaps in their process. Do you think you guys will ever start solving banking issues where you go to the source and you go, here's some solution? Is that coming down the pike in the future?
I can't say that that's coming down the pike. I think what I can say is we care a lot. We're passionate about making financing options work well for borrowers and for them to be transparent, to be efficient and reliable. And if it fits in one of those categories, know that we're thinking about these things constantly. How do we make this financing process more reliable, more efficient, more transparent for real estate investors? And so there's a lot of possibilities there. Tomorrow, lender ratings, next year, next 5 years, I think there's going to be more things that will come out that will be fitting within that same theme.
Super cool. So a new thing that we've done over on our shows is we bought things, right? So one of the things that I'm holding up is a bunch of cards, and on the cards they have conversations. It's because my little brain can only come up with a bunch of questions. So we're gonna pick a card out of here. So you tell me when to stop.
Stop.
All right, I'm gonna grab one of these cards right out of here, and I'm gonna read a question to you, and I'd love to hear your answer. All right. Okay. If you could be any kind of famous entertainer, athlete, or performer, what would you do?
Oh, that's good. I'm going to go with. By the way, thanks for bringing a little element of game night into this podcast episode. This is fun. Maybe we can shift to apples next, and I would. It would probably be baseball. I loved playing baseball growing up, and I actually played until I was 19 and played in one wood bat league before I hung up the cleats. And I probably baseball. I mean, you have so many games, 162 a year, so you're getting to play the game you love every single day, and then the added bonus would just be if you're getting paid to do it, and people are showing up because they enjoy it. So for me, it would be baseball. I'd be a baseball player.
What position would you play?
Probably. Well, I did a fair share of pitching, which you do kind of at high school, college levels if you're any good at that sort of thing. But probably outfield, so I could play every day.
Oh, very cool, very cool. So back to deals, right? When it comes to StackSource, and when you're working with these different groups, what does the perfect, because you're scaling this side, and this is where you guys are experiencing massive growth, what does it take to be a really good capital advisor for StackSource? Like, what kind of people are you looking for?
Okay. Well, you don't need to have a background in baseball. But if you do, I'm happy to talk baseball. I'm happy to talk growing up in the New York City area. I'm happy to talk Yankees, but it could be, it's people with an experience, with experience in real estate lending, underwriting, or brokerage, right? And if you've been a commercial mortgage broker, that is the most directly relevant experience that you can have to capital advisory at StackSource. But if your understanding of real estate financing, underwriting is there coming from another role in the industry, that would be a great background for capital advisory for sure.
What kind of characteristics or personality, or what kind of things do you look for beyond just their experience in deal making?
So beyond experience, to be a good fit with the team means that you have to believe in some of the same things that we believe in. Transparency is not just a feature of our online platform. Transparency is like a cultural value for StackSource in that, it's the way we treat our clients. We're not holding cards under the table that they don't know about. We're not going to hide some capital, opportunity for them because it's one that pays a lower commission. We want to really be transparent on every level with our colleagues. If you're uncomfortable with the fact that we know what we're doing, at the company, everybody knows what everybody else is doing, the capital sources we're going to, who we're going after as targets, it's not going to be a fit. You're going to have to be some level of tech savvy to guide people through this online platform for financing. Though you certainly don't need to be an engineer or a wizard in any regard. You need to be a bit open-minded to evolving with us because we're going to evolve the industry forward. And finally, honesty, integrity. You need to have honesty and integrity to be a good fit on our team because. Again, it's the way you treat your clients and the way we treat each other as colleagues. It's that level of respect that what we're doing is important and it matters, and we're going to be 100% honest and above board.
Very cool. So for the deal makers in the audience who have that experience, who want to explore that with you, what's a good place for them to connect with you and maybe go through that process and maybe see if they're a good fit?
There's a specific page on our website, stacksource.com/join us. So stacksource.com/join dash us. But if you go to stacksource.com, I'm sure you can navigate to it in the bottom as well, if you can't get the link to work. But it describes, what we're doing as a platform, how it relates for a commercial mortgage broker that may be considering a more tech-enabled approach, what the benefit may be, what the trade-off might be. So that would be good. But also, just emailing one of us and starting a dialogue. We're relationship people too, Josh, and we can start a dialogue. So you can reach out to Tim at stacksource.com. That would be me. You can reach out to Richard at stacksource.com if you'd like to talk to the gray head that's leading our originations platform that's been in the industry for 30 years. Why did he join StackSource? You can ask him that question. And that might be a good way in if you're very experienced in the industry. Why did this executive on the West Coast, who's been an executive at these banks, why did he join StackSource? Why don't you reach out to Richard at stacksource.com, and that would be a great first step.
Yeah, and we should probably interview the guy too to find out his story, and I'll ask him that question. Why did you join StackSource? So
there you go. Great first question. Is that question in the box?
It was no, that came out of my own brain. Can you believe that? I did it. Mom would be proud. So Tim, what question should I have asked you during this interview that I screwed up?
Josh, you've asked me some great questions. Box, no box. It's been great. You've done a great job. I mean, you can ask me another 100 questions if we do episode 3. What do you think?
Yeah, well, I'm sure we will, man. I'm sure we will. So let's do this one more time. Give us an idea of, for people in the audience, they're real estate investors, they're working on a commercial real estate deal, or maybe they want to put different types of their own resources into a deal. Where can people go to start that process?
Yeah, stacksource.com will get you to any of this and the team that you can find in the About Us page. But happy to field any inquiries directly. Tim at stacksource.com. You can find me, Tim Milazzo, on LinkedIn, Facebook, Twitter. I'll be the first one to come up. My last name is spelled Milazzo if you're listening only, and you can't click on the show notes for Josh at the moment. But Tim at stacksource.com, if you'd like to reach out to me directly, please do.
Cool. Very cool. Tim, thanks for being on the show. Fellow deal makers, if you're working on a deal, especially in commercial real estate, and you need some help with the cap table, head on over to stacksource.com, fill out a quick form, and see if it'd be a good fit for your project. And if you'd like to maybe come on the show here or talk about a deal, head on over to thedealscout.com, fill out another quick form, and maybe get you on the show next. Till then, talk to you all on the next episode and on the next deal. See you guys.